Hi everybody, Coburn Sheppick here from Dovetail Investment Group. In today's video, we will be discussing how the capital stack works in commercial real estate. The capital stack, or the capital structure, describes all the financial instruments used for the debt and equity of a commercial real estate transaction. It can be very simple, with senior debt at 80% of the value, with 20% of equity. It can also be more complex, a full stack, which can include senior debt, which is the first trustee lender, mezzanine debt, preferred equity, and common equity. Starting with senior debt, we all know about a traditional mortgage, which is the same as senior debt. This is considered the safest position in the capital stack. The senior lender, like Fannie Mae or Freddie Mac, typically lends up to 70 or 80% of the value of the acquisition. The senior debt is in first position of the capital stack, which means they have first priority in repayment. Because of this, they achieve the least amount of risk and the least amount of return. In the case of a borrower's default, the senior lender can actually take over the operating position of the asset. Next is mezzanine debt. Mezzanine debt, which sits behind the senior debt in terms of payment priority, offers a financial bridge between senior debt and equity. Mezzanine debt is typically shorter term and offers debt from 5 to 20% of the value or cost of the investment. Because of its position in the capital structure and priority above equity, there is less risk but still has a cap on the return. Next is preferred equity, which is subordinate to mezzanine debt and has priority over common equity. Preferred equity is very flexible compared to mezzanine in the sense that it can have a fixed rate and or upside potential. Preferred equity offers a fixed rate of return and can differ for each deal and operator. Preferred equity and common equity can also be shared, which might mean a structure to offer a preferred rate with a hurdle that is split between the general partners and the limited partners. Preferred equity has priority over common equity. So depending on its structure, preferred equity could have less risk than common equity and capped upside potential. Lastly is common equity. Common equity, which sits at the bottom of the capital stack, is considered to be at the most risk within the capital structure because its position is subordinate to all other tranches of capital and therefore has the potential for the highest returns. Senior lenders require equity or skin in the game from the general partner, which is also common equity. In real estate, common equity investors will typically receive a preferred rate with a hurdle like 8%, which is structured within what's called the waterfall. After the hurdle, the sponsor or operator will receive a disproportionate share of the rest of the profits. This is called the sponsor's promote. Though common equity is situated at the top of the capital structure and is considered to be at the most risk with the most upside potential, not all common equity investments are created equal as it relates to the risk and return profile. A healthy preferred rate of return can also offer investors downside protection. Understanding the different structures across the capital stack is critical in making commercial real estate a part of your portfolio. How you allocate between debt and equity should depend on your investment goals, risk tolerance, and strategy, and will depend on the timing of the current cycle. As of doing this video, we are moving out of a historically low interest rate phase and now rates are rising rapidly. So when credit becomes tight, opportunities open up across the capital stack for passive investors.